Shall I get the record?
Let's go. Yeah. Let me know when you're recording.
Okay, you're on.
All right. Hi, everyone. This is Hugh Hawkins at Macrohedged, and just wanted to go over 2019 in the rearview mirror. Obviously, I'm not going to go over every trade. There's not enough coffee in the world to keep you all awake. So, but I want to go through some things that stood out for me in both, things that didn't work out and things that did, how they could be improved, slight errors that we made, that sort of thing. Yeah. So without further ado, oh God, can't get my words out today. Right, let's jump in anyway. This trade, 24th of May, Euro dollar risk jockey. Euro dollars, i.e. the stirs, not the FX futures. This was in the set 19th, and as you can see, quite a strong bull trend. Now jumping in here, the idea, hopefully you can see this here. So this is an early kind of version of some of the models that we shared, and we share on our Intel package that are being improved currently for version 3. So this is probably version 1, maybe you could say. So let's just jump through them. So price, volatility ranges. These are not anything amazing, as in the sense that I'm not reinventing the wheel with them. They're reasonably basic, and a little bit of thought. I'm sure you can get there yourself. You've got the USS, DSS, which are just gauges on one side of the skew, i.e. looking at the shape of the skew and how steep it is on the call side, and then how steep it is on the put side. Trend, this is just a simple trend model that's it's a composite trend model, i.e. there's multiple inputs, and then obviously once all those inputs, like when all the green lights come on for the trend, then it goes bullish. So it's not just one thing that's turning it bullish, bearish, or neutral. Then I've got IV, which is percentile IV over the last year, and our version of the risk reversal, which instead of just taking one spot on the risk reversal, so that the common risk reversal that would be kind of quoted would be a 25 delta, which is looking at a 25 delta call versus a 25 delta put. Well, the idea about this is we look at we give them different weightings, but we look at the whole curve, one side against the other. So we're looking at all the calls roughly versus all the puts, and we're comparing those two. So here we go. So the idea about this trade was that we had reached the upper end of the range, and we were seeing a lot of call buyers, aggressive, and we thought, as the risk reversal was up high as well, or a recent, a metric, well, an area where one of our metrics was saying it was overdone, we were starting to feather in and i.e. sell calls, buy puts. Now, looking back at this, where did I go wrong? Right, well, let's just go into the trade. So a lot of the, I've kind of given you the gist of the trade quite quickly. I mean, if you really want to, you can pause this once it's you get the replay. But this was the trade. It was buy the puts, sell the calls. Right? It was a 30 delta. Sometimes you can't be you can't get the exact deltas you want in the euro dollars. It's very well, that's the problem with it, right? Because it doesn't have lots of strikes, and you'll find that. So you can either interpolate through the strikes, or you can or you can just pick a slightly different strike. Right? And so we went for the 30s. Now, the risk we originally went for was 200. Now, those will remember here, the euro dollars suddenly went parabolic. Now, what's common and what we should have done was make this a delta neutral risk reversal. But I was trying to play a little bit directional and a little bit of skew at the same time. And so I'm obviously playing the fact that the puts are undervalued and the calls are overvalued, and also that I think we could start to see some downside here. Now, in hindsight, that was stupid, right? Well, we know that, right? I should have just gone delta neutral, i.e. gone long here as well, right? So because obviously if you are, say you're selling the puts, you are essentially, you have positive deltas from that, right? Because you're selling puts, which are an asset that would gain if it went down in value. and you're you're buying the puts, selling the calls. So you're buying the puts, which would go up if we went down, and then you're selling the calls, which would go up in value, or your P&L would go up in value if we went down as well, roughly speaking, right? And so you kind of juiced it from both sides. But really what you want to do here is just then go and buy some futures, or I'll go on later on and describe a better play and the reasons behind a slightly different way. Those that have been around this and seen some of our trades, this won't be new. But essentially here, the fact that I didn't make this delta neutral was the whole reasoning why this, or the whole reason why this didn't work. And I think, in hindsight, that's definitely something I would do, and I'd be very probably unlikely to do an unhedged risk reversal, even though you're like, okay, let's keep the size small. Before you know it, these things they get away from you. And I think I ended up losing a little bit more than 400 a unit as well, which was more than twice what I originally wanted. I think it was more like 600-700. I think I lost a unit. So this stung. And obviously it's why you keep these things small in size and everything else. But yeah, it is what it is. I mean, yeah, I wish I'd have done it differently, but all I can do is learn from my mistakes. I didn't blow up, but or anywhere close. But it was just it was a stupid trade, in the sense that the idea was great with the skew, but the execution was poor by just not making it delta neutral. So I'm sure that there you go. There's the trade there, and you can see here that it has nearly negative 60 delta, right? Because obviously the 30 delta from the long put, and then selling the call, you're getting the 30 there as well. Okay, I can't do anything about it now, but ideally we should have got rid of these deltas, or at least reduced them down. I maybe done 2 units of this and then got long a future. So we only had, I don't know, like 20 deltas or something like that net short. So the sting wouldn't have been anywhere near as bad. And we'd have, at least made some money, or not lost a ton. Moving on, man versus crude. So this is another risk reversal play. So we're going to go through some of the couple of different types of trades I want to go through here. But these are the ones that stand out. So obviously crude, right? Every time you see crude have these big moves down, you'll notice, so we've got these metrics that we run, and you'll see as we progress through the trades, and so we're going through the year, that some of our metrics have kind of improved in the way that we're displaying them. And they're slowly, they are slowly coming on. The models themselves haven't really changed, but just the way that we share them and display them with people has changed slightly. So there was this grid at one point. I really want to get back here, but there was a lot of errors that would occur with it. So we were coming into some problems with it. But anyway, so this is, as those who remember, the last chart was in Bloomberg. This was one of our own charts. And you can see you got the price, volatility bands, implied volatility in the background in magenta. Then we have our trend model, our USS and DSS, so the upside skew, downside skew. And then I've overlaid here our kind of value-based risk reversal, which is showing you the whole skew that I spoke about, one side versus the other. And then also what the 25 delta skew looks like as well. So the 25 delta risk reversal, just so that way you're kind of seeing a gauge of something that you could really trade. And obviously, as you can see here, risk reversals through the floor. So was our model. People were, absolutely paying through the nose for puts. No one wanted calls. I mean, both of these are telling you the same thing. Low end of the range. Brent, very, very similar picture. And then we just go to our quick strike charts, and this is just showing 30-day risk reversal skews to 25 deltas. You can see here we're getting on for minus 10% in here, and we know that this is just way out of whack. Again, in Brent, obviously the financial Brent contract, not the not the ICE one. So it's obviously got a little bit less history here, but still same thing, right? I mean, just once you get into the the 7 to 10% negative area, this is where you want to start paying attention. This is something I wanted to include. I was showing you the shape of the skew. Obviously, the skew with IV on one, IV on the Y, and delta on the X. Now, if we go here, so we'll look, because people go, why 90 delta? No, this isn't 90 delta. This is just the way that the charting platform that I'm using here was displaying it. So here we've got the 50 delta in the middle, and then the puts are right, and then you can imagine that we're going the opposite way for the calls. So like this is actually the 60 is actually a 40 delta, 70 is the 30, and then all that to 90 is the 10 delta call. All right, so it's pretty simple. Essentially what I've done here is I've just displayed, let's turn these off, and we'll talk through them. All right, so going through, this is what the skew looked like on the 17th to the 3rd of 15, and then a month later. So you can see how how high the skew was as well, and how bent out of shape it was, and then how we shifted back lower. Very similar again occurred in 2018, and then obviously we were back in 2019, and we didn't want to go through loads of examples of this in the sense of just showing you loads of times when the skew's bent out. It's kind of, it's a bit like seasonality. You can go back for the last 20 years and find them, but how relevant are they if you're looking at them if you're looking at them this is the problem with a lot of things. You can go back and build a big sample size, right? But I don't know how relevant that sample size is to these days. Anyway, so this was what we were projecting, just based on the last two occurrences that we saw the risk reversal bend out, that we'd likely see, where we'd likely see the implied vol. This is the average before and after, and obviously that you saw the net change in IV bend, and obviously the whole shift down in the curve. What you could do here is normalize for implied volatility. That would be an interesting way of looking at things, and it's something that I am developing for the version 3 of the intelligence model. So you're seeing here a normalized skew curve, and you're also seeing what what is normal for the skew curve, because strip away the IV, and then you want to see, okay, well, what's the normal shape of it? Where is the skew curve bent out of shape? And if skew curves are new to you, or they're confusing, you probably should just take our course. I know it's a shameless plug, but it's the easiest way for me to explain it to you quickly. So how did this change? So this is different from the last risk reversal I spoke about, right? And the reason this is because we did the 25 delta. So we did 2 short puts and then 2 long calls, right? So then that is giving us basically a long delta position of roughly 100 delta, right? So we need to sell 1 futures contract against that. Let me just pull up my notes just to make sure I'm saying everything that I wanted to say. Yeah, exactly. So this was here. So now the problem with these here, the way of setting this out is, now a lot of brokers will offset a hedge, and they'll give you a reduced margin, and they'll take the futures hedge as a hedge, right? But some won't. I think I got some questions from people with Interactive Brokers, which is a really common platform. Can't really recommend where you go for brokerages. But some people were Interactive, and they were like, look, they're not offsetting the margin here. So they were asking them for a huge amount of margin on the risk reversal, because obviously we learn how in the euro dollars position, how even though when you size it small, these things, they go against you quickly, and they hurt. Now, crude, I mean, bit of a different beast as well. And you can imagine they wanted a lot of margin, and they weren't offsetting the fact that you were delta, you were making it delta neutral with the futures. So when I've got another risk reversal play in a minute that I'll go over, where I think that suits the I think that suits the way that you can kind of control the margin and also still play the idea as well. So this was actually a really successful trade, but that's kind of irrelevant in the sense that, yeah, I mean, the skew bent straight back. You'll if you go and look at yourself, have a look at any of the risk reversals. I mean, we came straight back in. I think, in hindsight, we took it off a little bit early, but we were sitting on huge chunk of profit, and it came very, very quickly. I think we've got some notes update at the bottom. Updates are always in green. Yeah. Yeah, so I made a mistake in the sizing. So we like to keep everything transparent in the sense that any updates I make, I won't just go and edit it. I'll leave everything in place, and then I'll just put it in green here. And then obviously, if there's any, you've got any questions, you can always let us know. And then obviously this went on, not that long, and it was up. Like I say, in 3 days we were up 4.5% on the portfolio. So we just said, look, let's just flatten up. It was too much free money too quickly. So that's that one, right? So might as well just find the other risk reversal. Here we go. Amazing skew. I mean, these are some amazing puns. I know that.
What would we do without your puns?
Exactly. Right. I mean, thankfully, the research is better than the puns, because I would not get employed, or I'd not be able to run a business if I was just writing puns. I'd be out on the streets. Right, so basically same thing here, right? So you can imagine that this is in corn, funnily enough, and sort of rapid rise up in corn. And then obviously you saw the risk reversal blow out as well. No demand for puts, same odd thing. Everyone wants calls. Everyone's literally trampling on them over everyone else just to get just to buy calls. And here you go, very similar to the last one. And you can see here, top end of the range. So these risk reversals a little bit boring, but you'll see the progression in a minute. So now, the astute people amongst us will notice here that we've got a risk reversal on the outside here, and then they'll notice two positions in the middle, and they got the same strikes as well. Right. So the idea here is we're doing the risk reversal, and so we're short the calls, long the puts, times 2, 25 deltas. So now we've got minus 100 deltas. So we've got to get rid of those minus 100 deltas, or essentially one futures contract of deltas that we are short. So we need to get long. Now we know that if you just get long, in the futures market, then a lot of brokers are not offsetting this. But let's split this up, right? So this is one trade, and this is another trade. All right. So these are essentially just two ratio spreads, a ratio spread in the calls. So you've got a short ratio call spread here. A long ratio call spread, and then you've got a short ratio put spread. You're selling the at the money and you're buying multiples of the out the money, and this one you're long the at the money and you're selling multiples of the out the money. Now, the reason this is so good is just a synthetic long position created by these two options in the middle, and because of the way this is, no one picks up that this has got the same payoff curve in the risk department. They really don't care that this has the same payoff curve as a risk reversal structure. They just they like I say, they'll just give you this for like 1/10 of the margin. So, I mean, you want to make your trades as margin efficient as possible. So I think this is a great way of doing it. We do talk about this, and this trade idea wasn't mine. I have to give all the credit for not the skew idea itself, but the way of playing the synthetic idea. This was all Nick at Quick Strike. This is his quick skew trade. Now, as you'll notice, this isn't as with every trade, there are, I suppose, trade-offs all the time. And you have to be very, very careful when in these trades, and keeping your delta exposure as close to zero as possible, because the idea, as we learned from the Eurodollars trade, when although I knew that you wanted to keep them delta neutral, I was just trying to juice the returns a little bit. And obviously you want to keep them delta neutral, but now in the passage of time and through other changes, those that know their second and third order Greeks will understand that other things can affect how your deltas will change. So your deltas won't stay constant, other than just price moving around, which then means that you will need to do some rehedging. And then you look at things like charm. So the passage of time means that you'll either decay or gain deltas, depending, right? So your deltas won't stay neutral. So here what you'll find is, if you're not careful with this sort of position, is you'll think that you're hedged on it, but you'll slowly either gain or lose deltas. And that could be why you'll end up making or losing money, because you're making and losing money on the fact that you now have a directional position, or a position that gains and loses based on direction. So that's one thing that when you trade these, you have to keep that in mind. But other than that, I think these are.
I think that's something as well that we've just realised as well, is that, because you don't see it in a normal risk reversal that's not got the quick skew trade, the pinned one as we call it.
Yeah.
A normal risk reversal, because you're because they do hedge a little bit more, you find yourself not really realising how much you're making or losing out of the underlying, rather than the true plot. That it's the deltas that are piling up the cash, nothing else.
Yeah, exactly. That's why
one of the good things about Nick's quick skew trade is it exposes that it's the deltas you're living on.
Yeah, and you have to be cognizant of that, otherwise. Otherwise these things can bite you in the ass. But I mean, this is not like just put it on and walk away and forget about it. So you have to keep an eye on it, and you need to make sure, ideally, you have a platform that shows you what your deltas are in real time. Right, so we might as well get all this risk reversals out of the way quickly. Right, so silver. Now, silver lining, why is it called that? Because the idea behind this was, we missed this parabolic move in silver. So for me, the silver lining was the fact that we could try and make up the bucks out of the skew. Very similar to the corn before. Obviously, blowout to the upside in the risk reversal. Now, and obviously this is just displaying the risk reversal via Nick's methodology called quick skew, which is comparing it compares the IV of obviously the calls in solid, and then the IV of the puts in a dotted line, or a dashed line, should I say. And it's what it's done is just essentially just normalizing for the at the money volatility. And obviously you can see they've blown out. Calls massive, higher, and puts are shit the bed, right? So essentially, let's jump in here. We did a little bit of a ratio here. That's just to try and balance it out. I think we maybe ran out of strikes, or maybe just to juice it up a little bit. No, I just went slightly lower. Anyway, so essentially what happened here is it didn't bend back. It just sat there. And what we ended up doing here was we didn't make too many adjustments to it, or we didn't make any actually, but you can see we've got a couple of negative deltas here. And eventually, this just kind of dithered around. And the fact that the skew didn't bend, and I can't remember exactly which way our deltas went, but we got a small move in our favor that we then just exited the trade. It was a long time afterwards. So, you have to be aware that as you start coming into, say when we entered this, we had, say 104 days to expiration. Now, this is another thing that will affect your deltas, right? So the same thing, right? As you come into expiration, you'll start to notice that you'll get exponential changes in a lot of your things, right? So like, as in, you'll start to see your gamma starts to, massively, your gamma will move, right? If you're long gamma or short gamma, that's what you got to be careful of, right? And obviously then your gamma is your rate of change of delta. So it means that your deltas in the position are wanging around. So then you have to be a lot more careful. and there becomes a point where you're like, okay, well, the skew will likely bend back at some point, but how much delta risk am I willing to give this trade, right? And at a point when we're just like, look, we're smalls in the money, you know, it hasn't moved anywhere near where we wanted it to bend back to. I don't think it had moved at all. We'd just gained money from being short the, most of the money was being short the 19 call, right? You got given a little bit of money there, lost a bit here, and not really done much in the middle. And you know, eventually you just have to say, look, let's just get out. It's not worth tying up the capital anymore. And something you definitely notice, there are some assets that the risk reversals don't bend back that quickly, and it just likes to stay bid. Maybe this is worthy of some further investigation into the silver skews, and why they stay bent out for so long. It kind of puts me off a little bit more of the lower liquidity products, especially things that, I don't know, it just like I say, the calls just stayed bid over puts, and it didn't want to come back. And with these, sometimes it definitely helps if you can try and time the underlying moving as well, because if the underlying had really turned back hard, you know, that then forces people to do, you know, to obviously puke one side and then buy the other side. So they're kind of being forced to make the skew bend. It's a lot harder for the skew to bend back the other way when obviously you're still seeing the upward price trend, and then you know, it's less likely to bend back. It still can. I'm not saying it won't, and I still don't mind taking those trades, but they sometimes don't work out as quick, especially in assets that don't like bending. This was kind of maybe this was trade of the year for me, or one of. This was probably the best trade that I put on, but it wasn't the trade that taught me the most. So anyway, you know, again, excuse the shitty pun. Essentially, this was so I built a model in the terminal to just to decide whether the market was net long or net short, using a couple of things. One of them being the City Index produced a couple of bits and pieces, and obviously the CFTC, you can kind of get a gauge on whether people are net long or net short. And I noticed that we were starting to get net long in here, and then obviously I've done the classic overlay here that you know, I do warn people against using on, like, especially zooming far out and then deciding that an asset's overvalued or undervalued because you've overlaid two things together. But this is just a simple differential between the 10-year yield of the Aussie and the 10-year yield of the US. I like that on short-term price movements. I like a couple of days, if you see the bonds not really moving, or, you know, the currency not really moving with the bonds, I think that's interesting. I don't think, like I said, you can't zoom out of a chart and then be like, oh yeah, the Aussie should be above 1 because you know, I've zoomed out far enough and this has adjusted my y-axis. So you know, on the second y-axis is now telling me this. I mean, if that's your thing, you should probably go get a job at an investment bank as an analyst. I mean, maybe one of the Scandinavian banks. So this highlights that some of the metrics that we keep an eye on, and kind of where we progressed with our tools. And obviously, so let's just run through these. So we've got price, I6A. This is the continuous futures contract. So you can see this has been in a steady downtrend, which is no surprise. And then I've got the at the money IV and the 1 month Z score of the IV. So, 1 year Z score. So it's just like a rolling Z score going back a year. The look back period for Z scores is up for debate. Happy to have it. I think between 1 and 2 is actually a great kind of area for those. And then we go through to call spread value, put spread value. I can't remember off the top of my head what the exact. I think these are quarterly, and then 2 standard deviations. So this is probably maybe like 62 days, something like that. Bollinger Bands. I like Bollinger Bands. I don't like them for price. I like them for mean reverting assets. Yeah, they work okay on mean reverting assets, or well, kind of mean reverting spreads, I suppose. And then you've got call spread value, put spread value. When I mean call spread value and put spread value, I mean, I'm comparing, say, and this doesn't really matter. So like, don't hold me on the exact deltas, but we would be comparing, say, an almost at the money. So say maybe a 40 delta call to a 10 or 15 delta call. And then I'm seeing the relationship between those two, i.e. like how much are they demanding, or what is the IVs essentially for the out the monies? When do they lift them up? When do they crush them down? As an idea of the demand or oversupply of the out the money versus the almost at the money. I think that's an interesting way of looking at things. As you can see here, you saw that there was people were loving. They were thinking that there was great upside here. They were long, net long, as I showed you before. From my metrics, they were at the top end of the range of the call spread value, bottom end of the range of the put spread value, almost naturally, because you see an almost symmetrical skew in currencies. Again, skew shape. It's kind of a talk for another time, and there's kind of an assumed level of knowledge for this discussion. So I'm sorry if you feel like you've been left out a little bit there. You pair this in with the next part, which obviously IV, low end of the range. So here was just sell an at the money put and buy 4 times the out the money puts. Now, this created something called a short put ratio spread. Those of you that have been around a while will recognize this. This was $42. Now, so you see this $42 and 42 ticks, sorry, which is $420 to buy. It's 100,000 notional and 100,000 multiplier, I should say. And you can see the way that this gains in an exponential fashion as we move lower. Now, as what we know with a lot of things is there's almost an inverse correlation with implied volatility and the price movement of the Australian dollar versus the US dollar. When the Aussie dollar shits the bed, you suddenly see a spike in IV. It doesn't have to be a big spike, but you generally see a kind of bid in the IV. Right, so I want to have some long Vega exposure. Now that's come at a cost because I'm paying theta decay for that, but I can get a little bit of positive Vega on here and still get paid handsomely. And you'll see in a minute when I come around to the next Aussie position that we did, and you'll see we flipped it the other way for the long side, and I'll go over why. So anyway, I don't really want to go over this too much in the sense, oh, look at this winner, wasn't it great? Because, I can just go through and show you winners, and that's kind of really not the point of this anyway. Let me just double check my, so this, in my opinion, this was a great example of using like the positioning, the low implied volatilities, and obviously the picking the right side and the way to play it, i.e. the call spreads are rich, the put spreads are really cheap to buy the out the money and sell the at the money. But this did come at a cost that you got the belly risk, right? So if we hadn't timed this well and hadn't started motoring down, you really want to get through your lower strike. So you want to be through the 6,900 area as fast as possible. Right? Why is that? Because you just see, you see the spread increase in value much faster when you go through that lower strike, or the out the money strike, I would say. Again, the only downside in this was we didn't get enough filled. We weren't aggressive enough in getting our trades on. Now, a lot of our trades, they just, if you've got to do a bit of size, you can just go in and start banging the size on, but you don't all work. You'll end up moving the market because it's not like it's not that deep, especially in these kind of they're not exotic options at all. But they're just not that deep because most of the currency stuff goes through OTC market. You ring a prime broker, your kind of standard ones, and most of them will quote you an OTC currency option. So I think we got like 13% of our what we wanted on here, and this turned out to be naturally and like an 8-fold winner, something like that. which that's the one that got away. But there you go. My lesson for this trade was should have just smashed it at market and just like got it all done. You know, even if it had cost us 10 ticks, it was definitely worth the 10 ticks to get on board. Well, worth the 10 ticks in hindsight. And as you can see, we just smashed it on the, we just bought back a load of futures and then slowly worked our way out of the options, because a lot of the time, if you've got size to do, that's the easiest thing you can do. Just get some future, buy some futures, and then just slowly dribble the rest out. Right, so let's save the S&P one, and we'll go loon to the moon while we're on this. Yeah, we'll do this, and then because I've got another ratio spread, and then an error that I made in the S&P, and then I want to go over the sterling trade from the election. So loon to the moon. Now the idea of this was that we were bullish the CAD against the dollar. Hold on, let me just get some water. Bullish the CAD against the dollar, so we're looking at the 20 delta calls versus the 45. So this is kind of that idea of comparing the the out the money to the almost at the money. And although the spread wasn't on its arse, it was in its lower kind of area or lower range of recent times. So the idea here was to sell an at the money and buy 3 out the money. So you notice here that it's not even the it's not actually that wider spread, in the sense that we're only 100 ticks apart, and there's only between these two there's only one more strike, 76.50. Now the exit the trade within 60 days. I think we did it about that. I think we might have given it a few more days extra, but because what happens here is you even though you're right, we weren't right enough, if that makes sense. And what you find here is, as time passes, these lines are showing you your P&L, and you slowly drop down. And then if the IV doesn't go either, which it didn't, as in like, because you've got, if we look here, you can see, well, you might not be able to see, but trust me on this, you've got positive Vega when you've got a 1/3 short ratio spread on. You've got positive Vega, and obviously as the IV drops, you're losing money because obviously you're long Vega. So really the trade here would have been to literally do the opposite. So it would have been to maybe buy 1 at the money and then maybe sell 2 out the monies, or to do something like a call ladder or something like that, which would have given me much more time, even though I was wrong anyway. Right, we didn't move up, but the problem was I think I could have structured it in a slightly better way. But then I'm saying that to you with the benefit of hindsight. So always it's hard to predict where vol's going to go and price, but I think you'd sometimes better off just with these kind of these short ratio spreads, is you really want time to be on your side, because that you pay to play, and you really do pay on these. I mean, you're just buying out the monies, right? And that's where you end up getting crushed. So this trade didn't work, but again, it's just want to show you that there is a trade-off between these exponential gains and the extra loss. If you just sit and you slowly move lower, you'll slowly drop, or slowly move higher, you'll slowly drop into the belly, and then you'll move into this belly faster if things like Vega start to collapse in your long Vega, which you naturally are, and that collapses, you'll drop in here faster. One way to sort of test this out for those that got quick strike is you can move the at the money vol up or down, and that'll give you an idea of how much this is shifting, and you can also move the days to expiration around as well. All right, so that's loon to the moon. I mean, it's not really, there wasn't the thesis, there wasn't a huge thesis on this. It was more that it was just undervalued, and I liked it. It is what it is. I'm not going to go and look at this trade and think, oh, I should have done something different, other than I think I could have structured the trade slightly better. I think this was hot on the heels of another successful ratio spread trade, and sometimes you've got to kind of pinch yourself a little bit. But what are you going to do? Right, so let's get into another one of my favorite trades of the year. It's called U-Ripper. Now, this is another ratio spread, and obviously this worked very well, but that's kind of not the point here so much. An interesting thing I'll give you is I always bang on about how I don't like trend lines. Well, I don't mind auto-drawn trend lines to give me an idea of where people are drawing trend lines. And there's one in, there's a tool in TradeStation that you can run. I don't change any of the settings. I just run it, and then I kind of look at it and I think, okay, well, you know, how has like things like the skew changed after this trend line broke? You know, what are we seeing in other metrics to see, you know, are we seeing people start to like try and press these shorts a little bit here and press the downside, and then obviously once they get squeezed out a little bit, you know, my thinking here was we would start to slowly drift higher. And we look at things like, you know, the COT report, and obviously this is a COT report for non-commercial positioning as a percentage of open interest. Been over certain pros and cons of doing this. Obviously, you got to be careful you track the open interest number as well, because if the open interest number changes, things could change dramatically. Although the actual short positioning hasn't changed itself as a percentage of open interest, it will have changed. So you have to be careful there. But anyway, long story short, excuse me, it's on the low end of the range, and I felt that people were getting a little bit cocky. The IV was very low as well, so we wanted to keep our exposure to that low, but but then we wanted to understand that, you know, most of the time when you see the Australian dollar rise, you see the implied volatility fall, right? So if we were betting on the upside, we wanted to make sure that we either had very small exposure to we wanted a small exposure to IV, or probably not negative, just because I don't like selling vol right on its arse, because it's just asking for trouble. But this is the interesting part, is we saw people in the risk reversal, they're actually getting a little bit long here. Well, that's probably the wrong word. The risk reversal was rich, i.e. people were paying over, or the IV for the call side was higher than the IV for the put side, right? So suggests to me that maybe there's a bit of demand on the call side, right? Or the calls are slightly rich. So then that, so this is just a fair value currency model as well from our friends at Citibank. So just showing that the Aussie is undervalued. It's like quarterly bars or something like that. So yeah, it's quite a long-term model, but it's just showing you that we could start to see some potential rallying here. And we'd also there wasn't any kind of rate differential moves that I was like kind of watching, keeping an eye on. So anyway, so we go through the recap here. Bullish price, neutral eye vol, need time, skew currently rich, right? So put that together, you get a call ladder, right? What's a call ladder? This looks almost like the opposite of what we had on before. If you flip it around the other way, is that we were looking for this exponential gain, not looking to it to get into the belly, right? But here we want it to be in the belly and not the exponential gain. Now let's jump in. So what have we done here? We bought an at-the-money call, sold. So we bought a 68, sold a 71, sold a 72, right? And we still managed to get ourselves net 40 deltas, right? And almost flat Vega, right? You'll get shorter and shorter Vega as you get up, and as these out-the-monies become closer to out-the-monies. But what I like about this is it's got a nice wide arc here. So you're seeing you've got a long way for price to jump before you need to do anything. And also it's got a nice area where it can fall into. So you don't have to be too accurate. And obviously you want to keep the DTEs a bit lower on these. So, just mainly so you can see the bleed out, because obviously the theta decay gains exponentially as you come into expiration. And again, the reason I like this is just because IVOL's likely just going to either just sideways or go lower as you go higher. So you want to be funding this, at the money strike here with this by selling these upsides. This is like the perfect, when I'm looking at equity markets, if you want to be long an equity market off the lows, this is a great strategy for that, because what happens in an equity market when it's on its lows, it's likely going to have high IV. So you're going to want to make sure that you've got very limited exposure to the via like, you know, flat Vega on the way up, or maybe even a little bit of short Vega on the way up. So these are a great strategy for that. This was a, you know, a profitable trade, but it's in the sense that we got, you know, because we got paid on the deltas, right? So, I mean, but that's almost irrelevant in the sense that I think it's more the structuring of the trade, where the skew was, how you expect the IV to react. So let's go. S&P won't let me be, right? So this is the trade where I fucked up. Essentially, this is a zigzag or a two. Hold on, I'm seeing questions come in. Okay, so I'll get to those in a minute. So yeah, so this was a downside bet. It was a small kind of, well, I say bet, it's whatever you want to take it as, right? It's downside positioning, and kind of based on, you know, I thought we were just gonna, you know, kind of start sitting and maybe move smalls lower. Maybe the equity market was done. How wrong was I? So I started to just get into this, right? So it was just two put spreads together, right? And the reasoning for the trade, irrelevant here really, because it was going to be a loser no matter what, in the sense that, you know, we were trending higher in that sense. I'm not looking to say, oh, how could I have avoided this loss? That's not really what I'm trying to get here. So what you'll see here is I've got a long put and then a short put, a long put and a short put. All right. Now, as you can imagine, as we go up, the short puts, well, all of these puts go down in value, right? But the ones you're short, you're making money on, right? So the temptation here, and this is exactly what I did, and this is wrong, was I bought back these short puts. Now, you might be able to buy back the very bottom end, right? But what you've got to be really careful of here, and if you take away one thing, is covering short puts, right, or short anything, the short side of the spread. Never cover it if it's worth more than a few ticks. And I say a few, and that depends on the asset, because a few ticks in the euro dollars, i.e. the stirs or a stir, is massive. A few ticks in, say, something like crude is nothing, you know. So be careful about it. But this essentially, because the idea here was you buy back the shorts, the short puts, and then you need a smaller rotation lower for your long puts to get a little bit of value back, so you can lob them out as well. It wasn't that you were going to try and save the day, it was just you were trying to reduce your overall loss. So in the end, I actually managed to increase my loss on this. Which I'm almost glad of, right? Because how many times you'll do that and then you'll get a bit cocky. So it's best just take kicking the balls first time, and then you learn your lesson pretty quick. So like the risk reversal in the euro dollars I spoke about earlier, again, another one here. Learned my lesson quickly here. Well, not quick, because this was a real pull the plaster off extra slowly. Because it was just grinding high, I would never pull back, and you're just sitting there thinking, "Come on, all I want is a small rotation lower. I just want to mitigate some of the loss on this trade," and just won't do it. And that's just the way it'll always work when you try and be a clever dick. It was a clever dick here. So again, my kind of takeaway for this was: don't buy short options back if they're part of a spread, unless they're like literally, you know, almost at cabinet. Right, so going on here, because I've got to be done by the top of the hour, so we're going to try and fly through this. It's called Don Johnson. This is our trade over the election. Now, the reason this made money was actually due to luck rather than anything else. Now, I'm not really here for luck. I want repeatable strategies. Even though we made 75 ticks per unit, which is, at 625 a tick's okay profit, but still not good enough in my opinion. Why is that? Let's just go through the trade quickly. Obviously, those that remember. So now this is slight update on our kind of models from what you saw earlier. Very similar though, price, IV, trend, the value-based risk reversal, i.e. the whole skew, and then the 25 deltas. what you can see here is they are, you know, they're basically at the floor. You're seeing people overpay for short-term downside, essentially. And you can see that here. I'm comparing this is just a different way of looking at it. Is you're looking at the spread between the 1 month call and then the 1 month put, and you're seeing, you know, not only are they're sitting on the whole IV structure, not it's gone up a bit, but not that much. But you're seeing the calls get crushed and the puts get bid over, right? Standard stuff. Now here I'm looking at this is the trade itself, right? So the idea here was that the calls were overvalued. So what you could do here is you could sorry, hold on, let me just double check the trade. Yeah, right, okay, yeah. So I was essentially, what I did here was I bought the out the monies, the 25 delta calls, and then sold the out the monies. Did that 4 times, and then offset it with the futures. Right now, ideally this trade would have worked, but let's just get through the rest of the analysis first. So here I was looking at rate of change of IVOL. So you got currency, IVOL, and then rate of change over 1 day, rate of change over 2 days. So I'm looking as, you know, rate of change showing me the percentage change of the implied vol over 1 and 2 days. Now I wanted to see what the maximum amount was. It was about 50% to the upside, about 1/3 to the downside, you know. And so that was kind of giving them a gauges to where we were. We were already quite juiced up on the IVOL front anyway. That's just the how the seat market was gauging up. Strong Tory lead, so this was kind of a little bit odd the way the market was reacting. So normally you'd think that we'd go for a risk reversal play, like the quick skew. You know, do the 25 deltas, get the net short on as well. Now, I thought this better way to play it would be to do this, to hedge in the buy the futures contract, and then obviously because the spread gives you minus 100 deltas. Now, the problem with this spread is obviously you see the risk reversal structure here as well, or the payoff curve, right? Now, it didn't actually work out this way. Why is that? Because the IV went from, say, 11.6 down to, say, give it a 7. So what happened is the whole thing shifted down anyway, right? So here we kind of, you know, what happened on the way up is we actually got shorter and shorter and shorter. We gained negative deltas because the out the money calls didn't gain anywhere near as much as they needed to. So, I mean, we ended up shorter and shorter and shorter, which worked because we got an aggressive pullback and we just got out on that. I mean, so I want to go on to the trade that we should have done. And then this, you know, took some, you know, thinking. And I mean, it wasn't just an easy thing just to, you know, like, oh, I should have done this instead, right? Because I go through and model things and whatnot. Right, so let's go through. So for those that join me on in the desk and everywhere else, let me just run through some charts here that I run here. Hold on, it's got the wrong chart on it. Sterling. Right, so here we go. Right, so I'll run through some metrics here. Yeah, right. Okay, so this is the difference between the implied volatilities for a 3-month option and a 1-month option. Right. Now, what you can see here, we're probably even better going further. You can probably do 2 weeks, but anyway, for example's sake, this is fine. So the trade here was people were paying up. So you see here, obviously, there was a huge demand at the start of December. Obviously, this is where it started. And let's just go through the metrics first. So thick orange, and then there's a thin orange here as well. That's just like thick orange is 1 year high. Sorry, thin orange 1 year high, thick orange 2 year high in this 504 period Bollinger Bands with 2 standard deviations. So like kind of 2 year look back, 2 standard deviations from your mean. Thin cyan, thick cyan is 2 year and 1 year low. And then an RSI, because I watch all these things in a quote board, and the RSI kind of tells me whether we are stretched or not. It's not really used for anything. I kind of, a bit cautious about, using these sort of oscillating metrics to just gauge whether something's overbought or oversold. But it's okay, because it's better to use it on something like this than price action itself, because obviously these things are very mean reverting by nature. Anyway, so how do we play this? What does this even mean? So this here is this here is showing you when this is low. This is showing you that the value of the implied volatility at the start of the curve. Let's just pull this up as well, right? I mean, if we're going to dive into this, right? So let's go FX, sterling. Let's go term. We only really care about the at the monies. We'll do right. So where are we with 12, and then put this trade on the 09 on the 9th of the 12th, and then 2019. Oh shit! Hold on. Up here. Right. Until it's late in the day. 12, 09, 19. Right. There you go. Right. Now let's just compare. Let me compare. Yeah, let's compare to a week later. So we'll say we'll do a week later. So we'll so election was on the Friday the 13th. Let's just go to say Monday the 16th. Right. Right. Okay. So this is showing you the at the money implied volatilities for 1 week to 10 years, right? So this is 1 week here, and this is 10 years here. So we're not really interested in 10 years, so we can probably trim this to 1 year, right? So that doesn't really matter, right? But what I'm showing you here is how do we play this, right? So, and this is everything at this point. So this here is showing you, right? So if we look back here, so at this point here, you're taking the 1 month here, this value, right, and you're comparing it to this value here, the 3 month, right? So the 3 minus the 1. Now you see the three went down a little bit, but the 1 got absolutely crushed. Now, if you are if you are brave, you're getting yourself out here. And the reason that I am not so keen most of the time in doing these trades here is because the theta decay actually ends up working in your favor. So you really want to see a bit of theta decay in case you're a little bit early on the IVOL selling. If you're a little bit early on the IVOL selling, I'll go into that in a minute, you kind of want a little bit of theta because it gives you a bit of cushioning. Right, so essentially here, this was the play, right? So let's go back over here. This over way. Oh, and the baby's crying. Oh. There you go, Thomas. Yeah, the baby's crying, so I've probably woken him up, and I'll be in the shit later for that now. So talking too loud. Right. So anyway, so the trade here, right, is straddle swaps, right? You can ask me what straddle swaps, right? So let's just build it, right? Right. Let's just build it in here. We'll get our date right first. Let's go in here. So we are Monday the 9th. So I'm not changing anything on the dates. We were still done on the same date, right? So we get our sterling in here. That was about the at the money for the spot, right? And let's just where are our Greeks? Oh yeah, we got our Greeks right. Okay, cool. Right, so let's add 4 legs here. Bear with me a second. This will all kind of make sense in a minute, and then the guys that are in the options desk will have seen me 5. All right. Right, so you got to remember this chart here, right? What we want to do here, right? We want to sell. We want to sell the 1 month, and we want to buy the 3 month, right? So, and then we want some exposure to the volatility, because the volatility is jacked up, right? So we want to see the IVOL come down, right? So we'll go through, and we'll do a say a 1 month here, a 1 month here. And so what I'm doing here is I'm creating 2 straddles. So we'll buy a call, buy a put, and we'll then sell a. So we'll buy. We'll buy the back months and we'll sell the front months. Like I said on the thing, we're buying the 3 month and we're selling the 1 month, right? So that's exactly what we'll do here, right? But you will notice I've done these in a million for each, right? Notional value, right? At the monies for the lot, right? And you'll notice here that we've still got positive Vega, i.e. per percent move in the implied volatility. This is telling you how much we have per percent move, right? So obviously if the if the IVOL goes up here, we will now gain 1,600. I think this would be in dollars, or is it in sterling? It's in dollars, right? So we'll gain $1,600, but we are expecting IVOL to get crushed. So we need to come in here and offset this. So let's just, for argument's sake, take this to 2M, right? But we're not outright, we're not getting too cute here, but we still are. Let's open the results, right? So here we go, right? So now I probably would have done this slightly more. Probably would have done 3M here, right? So, and you might have been able for this one event to pull this down, i.e. the number of days to expiration. You probably could have pulled this down and just done like a 2-week option or something like that. But generally, when you see these movements, you want to see. Let's just go down here. So we've got our Greeks, right? So you want to allow the theta decay. So you're gaining $1,000 in theta per day. That definitely helps you if you see a small spike in IV, because you'll say IV goes up 1%, you're losing $3,000, right, with this position, right? So the grand a day that you're getting back in theta decay definitely helps you time it in case you're a little bit wrong. Right, so results. Where's the spread value? Hold on. Yeah, right. Here we go. Right, so client receives. Client receives 30,000. Right, that's so much. It's a credit spread, right? So let's roll this forward. So say roughly you receive 30,000, just for argument's sake. Let's roll this forward past the election. Change this date here, and we'll go to we'll just go to the Monday. So we received 30,000, and now if you put the same structure on, you're only going to receive 12,500. So I mean, you're instantly yeah, you're right. That's why. Yeah, thank you. Yeah, there you go. This is the problem, right? So, right, let's just go back. Let's rework that. Apologies. Right, hold on. Let's go back to the Monday the 9th and put the trade on. All right, that should be right now. Right, let me just double check this. Sales call. Sales put, price call, 1M, 1M, 3M. Yeah. So all right, so very similar. It should now. Yeah, our Vega's like gone up through the roof, right? Now we've got a huge amount of negative Vega, right? And then please ignore these numbers. These are just like kind of hypothetical numbers that we're trying to I'm trying to show here where the profit would come from if you were to play this well. And there's a lot of applications for this in other markets. Right, so let's walk this forward. So we're saying here, client receives, say, 63,000. We walk this forward to the Monday next time, right? And then we see, obviously, Monday, client receives 52. It's because this has now gone, hold on, this way. Never work with option spread builders in real time. They're all terrible. Especially when you've got a monkey operating it. All right. Are we getting there? I think we might be there. Recalculate this not. Anyway, the idea here is, so say we were gaining 30,000 there, and then we roll it forward to the 16th, and then we got our 12 again. So you're seeing, essentially what you're seeing here is you're seeing the crush in the front month straddles, which is exactly what you wanted, but you've got the protection of the back month straddles just in case something was to go AWOL. It's kind of all I had for the evening, a little bit over on the time. So let me just run down the questions here. Jan, I can't answer that now. People want to talk about gamma exposure. Yes, this will be replayed. I'll put it on YouTube. Yeah, gamma exposure. You can't calculate gamma exposure for anything other than equities because, well, because of the calculating the gamma exposure takes into the assumptions that what the other side of the trader is doing, as in it's very similar to the assumptions that people make when they look at cumulative delta. They're saying, oh, this person's the aggressor, this person's the passive, and then they make an assumption. They go, well, the market's net short because someone's been banging the bid all day or something like that. Well, really? I mean, come on. So anyway, so this gamma, all these gamma calcs that everyone's chucking around, it's kind of got into vogue now. It falls apart. You can't do it in anything else other than equity markets. Probably be careful. A lot of things with massive assumptions built into the models aren't always great. Yeah, again, you got me right on that. So Kiri said about thoughts on layering the entries and partially take profits. Yeah, maybe. Yeah, for me, I'm just trying to be honest because I don't really care if I get it all on and you don't, sort of thing, or like you get it all on and I don't. It really doesn't matter that way. In the sense, I'm just trying to be transparent because I'm reporting a percentage gain. If you want to put the trade on, you want to bang it in market, I'm not there to hold your hand. I'm just sharing the research with you. Am I going to have to change the way I execute things in my new fund? Yeah, of course I am. Because I'm just going to do way more size. So that's just the way it is. It's not, you have to, so your execution is going to be very different from mine. Doing like 5 lots, 10 lots is very, very different to, doing multiples of that. But yeah, any questions? I mean, because I have to go soon. Just like DM me or send me an email, hugh@macrohedged.com, or I'm on Twitter. Skeward is changed my name a little bit because Trader 1906 was getting a bit boring, and I kind of reinvented myself in the sense that you won't see me having to go at anyone on Twitter anymore. So not got time for that. All right, thanks for coming along. Hopefully that cleared up some things, and yeah, any questions? Let me know. Cheers.